What's up guys, this is Muhab, and in this video we're going to discuss whether the Nasdaq, Dow Jones and the S&P 500 will fall from 10 to 30% in the future or not. So in case you don't know what happened in the past 3 months, which I highly doubt you don't, but just for a quick recap for this video, the Nasdaq fell by 30% top to bottom in March, and then it gained the 30% back again from start of April. The Dow Jones fell by 37% from top to bottom in March, and then it gained 27% back. And the S&P 500 fell 34% and gained 28%. So it seems like all of the three indices are recovering really well in a really short time. But will it last, or are we going to experience another downturn in these indices? So in this video, we're going to talk about 3 things. How much did the indices change in price year to date and the 1-year change? What is currently priced at the current valuations? Why the market may or may not drop? And then finally, I'll be giving my opinion and whether I'll be holding, buying or selling my stocks and why. But before we discuss anything, let's first, as always, roll the intro. The following table is going to give us a great insight about these indices and what people think about them right now compared to the overall average or compared to last year. And then after that, we're going to go into details and see what is actually priced in these indices. First, let's start with a year-to-date change, which means the change that happened in each of these indices from the beginning of 2020 until today. So as you can see, the Nasdaq fell by almost 3%, the Dow Jones by a whopping 19%, and then the S&P 500 by 13.31%. But how does that compare to a year ago change? So from May of 2020 compared to May of 2019. As you can see, the Nasdaq is up by a whopping 14.2%, which is insane when you think about it, because with all of what's happening right now, the Nasdaq is still up by 14%. So if you bought the Nasdaq in May of 2019, you would have gotten 14% in May of 2020. The Dow Jones is down by almost 8.5%, and the S&P 500 almost breaking even in May of 2020 compared to May of 2019. Now the important thing that we need to look at is the PE ratio, because it tells us how expensive are these indices, how much people are willing to pay for these indices at the current prices compared to its earnings. So for example, if you have a stock that costs $100 and it earns $10 per year, then its PE ratio is 100 over 10, which means it's equal to 10. So that's how PE ratios work. So the current PE ratio for the Nasdaq is almost 28, the Dow Jones is almost 20, and the S&P 500 is almost 25. But how does that compare to a year ago? A year ago, the PE ratio of the Nasdaq was less than the current PE ratio at 23, and same goes for the Dow Jones and the S&P 500. So a year ago, the PE ratios were lower than the current PE ratios, even though the prices are lower. That's because the earnings for the first quarter were lower. We need to take into consideration that the second quarter of 2020 results are still not out, since we're still in May. So in like June or July, when the second quarter results are released, the PE ratio is going to rise even more, because a lot of companies are not going to be making any profit in the second quarter of 2020 because of the lockdown. Many industries are pretty much shut down right now, and that's going to result in these PE ratios to shoot up even higher. Now you may ask, why would people pay for these indices at these prices? Well, in general, when a stock or an index has a PE ratio that is higher than average, that means people are expecting higher than average growth. So since the PE ratio now is quite high, people believe that in the third and fourth quarter of 2020, the lockdown is going to ease very much and everything is going to open back up again, which will result in high earnings and as a result, low PE ratio. So that's why people are still buying into these indices. There are more reasons behind that, which we're going to discuss soon, but now let's compare the average PE ratio, the mean PE ratio, with a year ago PE ratio and the current PE ratio. So as you can see, the mean PE ratio of, I think, the past 20-30 years is around 17.5 for the Nasdaq, 16 for the Dow Jones, and 15.78 for the S&P 500. And those are significantly lower than the PE ratio of 2019 in May and May of 2020. So we're still paying premium for the Nasdaq, Dow Jones, and the S&P 500, at least compared to the overall average. To understand how the pandemic has actually affected these indices, we need to understand which sectors do they include. So when we look at the Nasdaq is almost 50% made of tech, and the technology sector wasn't really affected much by the current pandemic. If anything, some have even benefited from it, like Amazon. However, there is no doubt that others like Apple and Microsoft's manufacturing and sales were affected negatively as a result of the pandemic. So not the whole technology sector has profited from the current pandemic, but some actually did. I talked about Amazon and the whole e-commerce sector of how they're going to benefit from the current pandemic long term. If you're interested in watching that video, feel free to click on the card at the top right of the screen. However, let's bear in mind that the Nasdaq has another 50% of sectors that are either in losses or barely breaking even. Unfortunately, many investors, when they think of the Nasdaq, they just think of technology stocks. So they know that most technology stocks was not affected negatively by the pandemic, so they put their money in the Nasdaq. Almost 20% of the Nasdaq is made of consumer services, which is pretty much dead and has been dead for the past 2 to 3 months. And we got healthcare, which almost broke even, I would say, or maybe they will see a little bit of growth, although I highly doubt it. And you got financials that is dead, industrials that is dead, and you got oil and gas that is dead, and basic materials are pretty much dead too in these 2 quarters. They may revive in the 3rd and 4th quarter of 2020, but again, we're still not sure. And for the current thing that is happening right now, the only thing that is benefiting is part of the technology sector, and the other parts of the Nasdaq are going to be in losses. Yet people are still investing in the Nasdaq, which is why we see 14% in profit in 1 year change and almost breaking even in the year-to-date change. Now we need to understand that these indices reflect what people think are going to happen in the future. So they don't reflect the current exact situation, because if they do, then they will be much lower in price. So many people think that in the future the Nasdaq, Dow Jones, and S&P 500 will be worth the current PE ratios, and maybe even more, because they're expecting to profit out of them. So let's not forget that, because many people, when they look at these prices and they be like, wow, why would people pay that price? Because they think in the future that the consumer services is going to revive, healthcare is going to improve, financial, industrial, and technology too. But it's also important to understand what is happening right now and to build on it for the future. So that's why I mentioned what's happening right now. On the other hand, when we look at the Dow Jones and the S&P 500, we can see they're more diversified and they're more balanced compared to the Nasdaq. The Nasdaq is more skewed toward technology, although it has other stuff too. But the Dow Jones has 22% industrial, almost 18% technology, almost 15% consumer goods, and more than 10% in oil and gas, which are all not doing very well except maybe technology. On the other hand, when you look at the S&P 500, it's even more diversified. It has information technology, healthcare, financials, consumer discretionary communication services. But again, the same thing. Most of these sectors are having hard time right now. Alright, let me now summarize what I said about the 3 indices in the past couple of minutes. Starting with the Nasdaq. The Nasdaq is up hugely, and in my opinion, its PE ratio is extremely high. Even though almost 50% of its weight is based on technology companies, which most of them did alright, the other 50% of its weight has done really bad the last quarter and are going to do even worse in this quarter. So in my opinion, the Nasdaq is quite overvalued. In fact, many people believe that if the PE ratio of these indices reaches 30 or more, we're getting in the bubble territory, which is very worrying. On the other hand, the Dow Jones and the S&P 500 are at a lower PE ratios compared to the Nasdaq. The Dow Jones and S&P 500 PE ratios are around 20 and 25 respectively, but they're higher than their average PE ratio and their PE ratio a year ago. Furthermore, all of these PE ratios haven't still considered the weak market of second quarter of 2020, which means the PE ratios will be even higher at the same prices. I think that the market has priced in that the economy will start to open up gradually, with the hope that the demand will be the same or even higher than before on many things. In addition, I think it's counted on that there won't be a second wave of infections. Furthermore, the Feds won't let the market free fall anytime soon, with pretty much the infinite support they're providing. They're buying shares, supporting companies to raise money and give people stimulus checks, or pretty much free money to everyone. Finally, we need to understand that with extremely low interest rates, the stock market becomes more appealing for people with billions to put their money in it, and that drives the price of these indices up, thus the high PE ratios. Alright, let's answer two questions. First, is it worth investing in these indices at these prices? Well, in my opinion, no. Because they're counting in a lot of the good news that might very well not happen. However, that doesn't mean there aren't individual stocks that are worth investing in. Second question, will we see another recession or a drop of more than 10% in a few days' time? Well, I don't think that the Feds will allow a very harsh drop anytime soon. They'll keep supporting businesses and the stock market, especially because this is an election year and Trump wants to look good to be re-elected. However, if we see another strong secondary wave of infections as a result of the ease in lockdown, then there is a very good chance that the market will strongly drop once again. And I'm not sure if the Feds will be able to withstand the selling pressure with their printers. And even if they decided to buy more printers and flood the market with more cash to prevent any natural drops in the market, then I think that will affect the Fed's reputation negatively. And worst case scenario, that might cause a change in the monetary system. But that's a story for another day, and to be honest, I highly doubt something like that will happen. Okay, so what am I doing? Personally, I am an individual stock investor. So I pick stocks that I believe will do very well in 3 to 5 years, despite what's happening right now. So I don't invest in any of these indices. However, I will hold the stocks that I own to gain any upsides from the market and these stocks, but I am not planning to buy any more stocks in these volatile times, and I'm planning to accumulate more cash meanwhile to utilize any drops in the future of these markets. However, I only bought one stock in the past few days, which is called Barat Developments. If you're interested in seeing why I bought it, then feel free to click on the card in front of you. Finally, if you're interested in knowing what 3 stocks I bought and planning to hold forever, then feel free to click on the second card in front of you. Alright guys, that's the end of the video. Thank you for watching. If you enjoyed it, please don't forget to smash the like button and subscribe for more financial education videos too. This is Muhab and I am signing out.